All right, so this next lesson we're going to talk about a couple more terminologies. The first one we're going to start with is cash versus accrual. And so what we're talking about here is that accounting can be presented in a few different ways. The two major ways that we talk about here in financial accounting for external reporting is cash and accrual. Now there's some other ones that we won't talk about, but those are our two basic ones. And they're really, cash is really easy. Accrual takes a little bit of time to understand. And so the first one's cash. Now, what is cash basis? Cash basis of accounting tells us that we book revenues when cash is received, and we book expenses when cash is paid. Okay? Now, kind of time out for a second. We talked about the matching principle. This violates the matching principle. Okay? The matching principle tells us that we match our expenses to when the revenues come in. Therefore, if we have t-shirts and we're selling them, when we buy the t-shirts, we don't expense them until we actually sell them. And so we don't put an expense of the 100 t-shirts on day one. Well, this violates it. So if there's a question on why we're learning cash, it's because we need to learn cash, but it does violate it. But it's pretty easy. Revenues, when cash is received, then we book the revenues. If cash is paid, then we book the expense. So going back to that example of the t-shirt, when I paid $100 for those 100 t-shirts at $1 a piece, then we book the expense. So we don't what we call capitalize them into the asset and then move them to the expense when we actually sell those t-shirts. Revenues, again, if I buy an airline ticket today to the Cayman Islands, I pay $1,000 today. For United, that revenue is theirs the moment that I pay them $1,000 under the cash basis. Now, accrual basis of accounting uses the matching principle. So revenues are booked when they are earned, typically by performing a service or delivering a good. Okay? And then expense is booked when we've performed a service or, same thing, delivered a good. Now that's a very basic, simplistic answer. It does get a little bit more complex, but think about it this way. We want to use the matching principle. We want to use the revenue recognition principle that tells us is that we book the revenue when we perform the service, or we have delivered a good and then we book the expense in pursuit of those revenues, and so that's when we book it. Okay, we do have different types of expenses. We have what we call product expenses, and then we have period expenses. We won't go into too much detail of theirs, but product expenses would be those t-shirts, and period expenses would be like utilities. As we're using the utilities, even though in some respects in the manufacturing process we're using the utilities now, we technically could capitalize that into the product. Those period expenses we would expense as they go on. So management's offices, management's utility bills for management's headquarters, those we would expense almost right away. So that's cash versus accrual, something that's important. A lot of times in financial accounting, we only typically talk about accrual because cash violates matching principles. We don't really learn it too much. We do talk about cash a lot when we talk about tax returns. All right, so categories and accounts, and this kind of gets us into kind of the bulkiness of what we learned in financial accounting as well as the bulkiness of accounting itself. The way that I teach it here is we have these categories, and within each category we have accounts. And so we've got 6 categories that we're going to learn today. The first one we're going to learn today is assets. Now, what are assets? Assets are economic resources owned by a business that have an expectation of a future benefit to the operations, okay? So an example of an asset would be like cash, okay? Cash is an asset because I can use that cash to invest in my company and therefore produce more revenues. Another example of an asset would be a piece of equipment. Same thing. I buy this printer, for instance. The printer makes a product, an advertising page, and so as it makes more of those advertising pages, it's producing more revenue, so that's an asset. So an economic resource owned by a business that are expected to benefit future operations. Again, we talked about cash, equipment, we might have land, buildings, inventory, and then money owed to the company in the form of accounts receivable. Okay. The second one that we need to know, and these are all categories, is liabilities. Okay. Liabilities are obligations of a business to pay either in cash or transfer an asset or provide services to other entities in the future. Liabilities, I like to just really call it things that the company owes to someone else. And it can be in cash, it can be in a service, or it can be in an asset. An example of like asset would be a customer pays you up front to provide them, a piece of equipment, but it takes you a little while. It's kind of their deposit. It takes you a little while, and then you actually deliver the equipment to them. That's fulfilling the obligation or the liability. So things that are owed from the company to someone else, whether it's a customer or it's a vendor. Examples of liabilities would be debts to other businesses, amounts owed to suppliers of goods or services. We call that accounts payable rather than receivable, and then loans from banks or credit cards because we're taking out the loan, we owe them, and then we fulfill that obligation by paying them back in cash. Okay? The next one's owner's equity. Okay, owner's equity represents claims by the owner to the assets of the business. Kind of examples of owner's equity would be the amount of money that the owners put into the business at the beginning, okay, or retained earnings. And so owner equity. Now there's three more that kind of go under owner's equity that we'll talk about it briefly, and we're only going to talk about it briefly because we're going to talk about it more when we talk about the accounting equation, and that's revenues, expenses, and dividends. Okay, so revenues, expenses, and dividends. Revenues obviously is income earned, hopefully through the accrual method, actually earned, or if we're talking about cash, cash received. Expenses are expenses that happen in the business, again, self-explanatory. And then dividends. Dividends would be kind of when the business earns money, they can do one of two things to that money. They can either retain those earnings and build the business more, or they can take the earnings and distribute them to the owners kind of as a thank you for investing in the company. Okay, so these are typically payments to owners for investment in the company. They're not an expense because they're not required in the pursuit of business. They're typically given as kind of, hey, thanks for investing $100,000 in our company. We've made $50,000 this year. We're going to give you back $10,000, but then we're going to take the $40,000 and reinvest in the company. Now, those are categories, and within each category are accounts. So we talked about examples of assets. We have cash. We have accounts receivable, inventory, liabilities, accounts payable, loans payable, owner's equity. Typically, we don't talk about this much, but common stock. Additional paid in capital. And then revenues, we might have service revenues. Expenses, we might have utility expense. Cost of goods sold, And then dividends are typically just dividends themselves. Okay, so those are categories, those are accounts. Another way that I like to explain it is, let's say you go to a bank, you go to one bank, but you can have multiple accounts at the bank. So you can have a checking, you can have a savings, you can have a credit card, you could have a multitude amount of accounts. And so think about, we've got 6 categories, and within accounting we have a bunch of accounts. So typically we can classify all of these accounts into one of these 6 categories. Now, this may be a little bit different than if you learned it somewhere else, but these are the 6 categories. They'll make more sense when we talk about the accounting equation.